For part 2 of this session, please welcome back Zanny, Minton, Beddoes, and the panel to discuss global capital markets.
Now we are going to discuss how to effect this transformational decade that Kristalina just told us about. And this is, I mean, this panel needs no introduction, but this is an epic panel in terms of actually affecting change. And I'm going to go in order just from the furthest there. Harvey, who I can just about see, Harvey Schwartz, CEO of the Carlyle Group. Ron O'Hanley, Chairman and CEO of State Street. His Excellency Mohammed El-Kuwaiz, the Chairman of the Board of the Capital Market Authority of Saudi Arabia. Mike Gitlin, President and CEO of Capital Group. And Jane Fraser, CEO of Citigroup. So we have banks, we have private markets, we have people who do the plumbing of financial systems, we have capital-rich emerging markets, we have everything here. So between you, there's no excuse to not solve and come up with all the answers. So Jane, I'm going to start with you, and you heard what Kristalina said about the US. The US has done, remarkably well. On the other hand, US valuations are also remarkably rich. And I wanted to start this conversation with kind of where we are in the capital markets before we go into big structural changes. I mean, is your sense that investors are pricing in, higher for longer? Have they not got to grips with that yet? What's your sense of where market valuations are?
Zanny, it's a great place to start. And certainly the markets have been on a tear, particularly the equity markets of late. And there's some good reason to think that this could continue. So if we look on, certainly the valuations are quite high on many of the metrics. Technology is a very high percentage in terms of valuation. But there's a potential for a win for equities here in the near term. Because if growth is stronger, equity valuations benefit. And if rates come down, equity valuations benefit. So there's this opportunity for a potential win-win here, unless there's some shock in the system, as Kristalina said, or what else would need to go wrong? You'd need to have quite a severe recession, or you'd have the unpleasant scenario of accelerated inflation and slower growth, which would really be quite a dilemma for the Fed. That's not the base case. And we shouldn't forget fixed income markets. There's some interesting things there. We've certainly had very strong debt issuance and a very strong start to the year. One oft overlooked fact: pension funds around the world are now very fully valued. And that is going to give them an opportunity to lock in returns. That could be an unexpected boost for fixed income to see some more flows going there.
So I'm going to put you firmly in the upbeat category. I guess you have to be, but that's okay. You're in the upbeat category.
I'm in the fairly optimistic category, short of a shock.
Fairly optimistic, short of a shock. Mike, let's turn to you, and I'm not going to go along the whole row with this, but what's your sense of where markets are? Because let me play the devil's advocate, if you will. The CAPE, cyclically adjusted price earnings ratio. I mean, you can take that for what it is, but it is higher than it was in the late 20s. I think only in 2000 and in 2021 was it where it is now, and both times after that the market corrected quite substantially. Should we just not worry about that, or is there a risk of a substantial correction?
Well, I am in the non-market timing category. It really is, and this is not just something people say, it's actually how it works. It's time in markets, it's not market timing. So trying to pinpoint right now whether there will be a 10% correction or not from where we stand today is generally not a good policy. You have earnings growth. Developed market earnings are growing 5-6%. The US sort of high single digits. Emerging market 15%. You have reasonable economic growth. Inflation is coming down, not as quickly as central banks would like, but it is coming down. So is the S&P 500 relatively expensive versus a cohort of high dividend paying stocks? Yes. Against small and mid-cap stocks, yes, and against international and emerging stocks, yes. So from a relative standpoint, you may suggest the S&P 500's relatively expensive. At the end of the day, there's plenty of individual opportunities. There's lots of idiosyncratic opportunities around the world, small and mid-cap in particular. So I think it's more about where do you find the broadening of the market opportunities and less about sort of the beta of the index.
I'm going to jump to the end. I'm going to come to both of you in a second. But Harvey, I wanted to ask you about the US dominance of this. I mean, if it is, US dominates, valuations are much higher here than they are elsewhere. The US is kind of, the story has been about the US. Why is that healthy? Will it last?
Well, first of all, it's great to be here with everyone. It's great to be on the panel. I think there's not really a particularly exotic answer to the US phenomenon. You heard in the prior discussion, Mike and Jane were just talking about it. You have incredibly strong earnings growth. You have interest rates that are high, relatively speaking, anything we've seen. I mean, if we were here 2 years ago, there'd be a 4 or 5 sigma event, they'd be up 5%. So it's like a 1 in a million probability, which as an economy we've navigated. So on the one hand, you have high interest rates, which are a good thing because the economy is strong. High interest rates, which is kind of a troubling thing because a lot of this has been fueled by the deficit, investment in green, data centers, infrastructure. But the economic activity that's underpinning all this is quite profound. I traveled the world a lot in the past year, and I won't say, you can't ever say anything's in totality this way, but I would say the vast majority of investors, my clients around the globe, when I ask them about the US, they would say, I'm over-allocated to the US, but I'm going to allocate more capital to the US. Depth of the capital markets, the attractiveness of everything we know. In terms of valuations, as micro investors across our credit platform and our portfolio companies, we see a lot of unique opportunities to create alpha over the next several years. On a relative basis, I agree with what Mike said. I think when we talk to investors, they don't see risk to avoid it. They see risk to evaluate it and its return potential. And so you might say that the US market is overvalued relative to another market. I think that's just a question of whether investors feel like that risk profile is most attractive for them and whether the risk reward makes sense. But I think this is the fact that we've had a 500 basis point increase in interest rates and things are as stable as they are and still adjusting to it, I think is we should all be quite grateful for it at this moment in time.
Mohammed, two questions for you from a perspective and a capital-rich emerging markets perspective. Firstly, how do you think about a world of higher for longer rates? What does that mean for you? And secondly, if we're in a world, as Harvey says, where people say, I'm over-allocated US, but I'm going to increase my US allocation, what does that mean if you're the regulator of a capital market somewhere else?
Well, thank you, Zanny. It's a pleasure to be here with everyone. I think the first question on rates, particularly as we look at it from a regulatory standpoint, most of the concerns that are directional in nature are less of a concern from our standpoint as regulators because the markets are meant to price in those concerns. Our main concern is about things that may have an implication on the robustness of markets and the orderliness of markets. And the main concern, particularly in higher interest rate and higher inflation environments, is lower liquidity. Because higher interest rates and higher inflation levels are likely to and have already had negative impacts on liquidity. This is true for developed markets. This is even more true in emerging markets, which tend to have more volatile flows. And if this extends over a period of time, the concern is what is the effect on price formation? What is the likely extent on orderliness of markets? Now, from our standpoint in Saudi Arabia, having been a country that has historically had very high levels of liquidity, this is not a concern because the higher interest rate environment is allowing us to essentially converge with the rest of the world. However, if we project forward, given expectations of things in the country like Vision 2030, like $3 trillion of investment, building in new sectors, and in some respects, building in new cities, I think the need of liquidity is much higher than it has been at any time in the past.
So I'm going to come back to the liquidity point because I think that also fits in very, very much with another structural shift I want to talk about, which is the rise of private markets. But Ron, just let's turn to you and your sense, first of valuations, but secondly, of this notion that capital allocation sort of seems to be sort of secularly increasing towards the US, and what does that mean for the way markets function?
Well, first of all, on valuations, I mean, I think you have to look beyond the indices, which are cap-weighted, and the Mag 7, which is just an immense part of all that. And we can go into the rationale for that. There's this bet on AI, which is probably a reasonable bet to make. But if you look on an equal-weighted basis, right, the markets are not, in my mind, overvalued. Right, there's an awful lot of opportunity out here, which I think is what Jane was getting at. So. Sure, if you're going to just buy the index, you may think that there's too much there, and it is overly influenced by the Mag 7. But I would urge everybody to look beyond that. Why I think Kristalina has given us the reason why so much has actually come to the U.S. I mean, we had a major economic and financial shock with the pandemic. We saw the unraveling of supply chains. I mean, there was moments there where there was really uncertain as to over what time period economies would recover. And the U.S. just recovered very, very rapidly relative to most. Kristalina talked about the repair of supply chains, which wasn't apparent that was going to get done so quickly. So I think part of what you're seeing is just a bet on the ongoing endurance of the American economy. But I also wouldn't leave aside what's going on in the rest of the world. I mean, we talk a lot about, as China's represented a lot of growth over the last 20, 30 years. What's going to make up for that? Well, there's two countries I would point to. One is India and one is Saudi. Right? If you think about the enormous kind of investment that's going into these economies and the opportunity that's going to be created by that. So it's not just about the U.S. and where the U.S. is in terms of, is it the only place to be? I think that you're seeing other opportunities for capital to be deployed, and I expect you'll start to see that.
So are we going to see that? Because if Harvey is right, or his clients are saying, I'm going to increase my capital allocation to the US, you may be seeing that less than you otherwise would. So, Jane, do you see any shift towards other areas?
Look, let's look at one of the structural elements in terms of the capital market. The US, we've got to remember, this is over 50% of the world's financial strength and firepower is in this country. So while the GDP in other countries are becoming a more multipolar world and they're growing in their percentage of GDP, the US still sits here with the depth and breadth of a capital market that is unique. You look at Saudi, huge amount of work there to build in terms of the reforms, build out the derivative market, securitization, et cetera, and bring that liquidity to bear, as Mohammed talks about. All very important work. It doesn't happen overnight. It takes time. Look at Europe. I think the big missed opportunity in Europe was a European capital market union. And as a result, you just don't have the depth of liquidity and capital market that you have in the States. So I think that advantage that Kristalina was talking about the dollar, also reflected in the scale and depth of capital market here, the structural advantage. It's going to take time for the rest of the world to build that out. It will happen, but that will lag the economics.
There is something a bit, interesting. I was about to say a bit weird, but I guess it's interesting that in a fragmenting world, you have, it seems that the US is the big winner, and the big winner certainly in financial market terms. And Mike, do you think that is a sort of secular, if we can say we can have all these costs that Kristalina talked about that come from a fragmenting world, but actually in terms of investment opportunities and capital markets and so forth, the US is where it's at?
If you did two things in the last 15 years, you were very successful. If you own the S&P 500 and you own the US dollar.
Yeah.
The S&P 500 annualized over 15 years at 15% return, which is super high. MSCI ex-US was about 7 or 8%. So you did twice as well by owning the S&P 500 and having a dollar asset. I think in the next 5 and 10 years, you'll see more interest in owning non-dollar securities. You'll find there's 1,000 companies outside the US that have greater than 3% dividend yield. You can find dividends, you can find small and mid-cap exposure. So I think also the term, when you think of geography, you have to be a little bit more all of us more mindful that the country of listing is less important necessarily. Apple. Is Apple a US company? Sure. More than 50% of its revenues come from outside the US. Starbucks, more than half its stores are outside the US. AstraZeneca is in Cambridge in the UK. 80% of its revenues come from outside the UK and Europe. So, you know, I look at obesity drugs. Eli Lilly's in Indianapolis and Novo's in Denmark. They're both solving a global challenge. So I think we have to be a little bit careful of the listing and more thoughtful about what's the company's business, what's its supply chain, where's its revenues, where's its opportunity, and then you find stock picking opportunities in those areas.
Mohammed, when you listen to that, you know, your job is to obviously oversee the smooth functioning of a different market and presumably its growth and development. And, you know, Saudi Arabia is capital rich, but it also needs to attract a huge amount of capital to do its transformation. It sounds to me like it's just much harder in a world where actually the US is sort of so dominant.
Well, Zanny, I would say yes and no. And this very much is related to both the previous panel and what the panelists on the current panel talked about. It is very clear that the US has been and continues to perform very well, both economically and in terms of the financial markets. But if we take a bit of a step back, the main overlay of most global investors is the paradigm of developed versus emerging markets. That is still the overarching paradigm of most investors. And if you are an allocator to developed markets, I can see significantly how an excessive allocation to the US markets is likely to have a cost on the other developed markets allocations. However, the allocation between developed and emerging seems to have more friction than allocation between developed and emerging. The other trend that we have been seeing is both because of the increasing size of the US in developed markets and the increasing size of China in emerging markets, is we're seeing a further bifurcation of developed ex-US and the US and emerging ex-China and China. So now you can imagine a system of 4 allocation buckets: the US, developed ex-US, emerging ex-China, and China. And this is also informed by the increasing polarization between those two countries. And in this new allocation paradigm, I can see how if I am developed ex-US, this is likely to have a negative consequence just simply because of the weight of the US. On the emerging ex-China, actually this has been having a positive impact because as these polls increase, there's more funds that are actually being allocated to the mean.
So I have never thought of it like that. That's a really interesting way to think about it. Ron, when you hear that division, does that resonate with the way you and your clients are thinking about anything outside of the US right now?
Well, I think it does, and particularly trying to pull China out of emerging, developing markets is actually quite important. And going back to the conversation earlier, I mean, if you think about what's happening in China and then the spillover beneficial effect to the rest of Southeast Asia, if you're an investor and you're starting to see this pulling back of certain trade activity from China, where is that going? Some of it's being reshored to developed markets, but a lot of it's going to new markets. So it's important for investors to think that way. I mean, the other point here that I would emphasize is that we're talking a lot about public markets, but private markets are also, in some ways, a much more, and private investing is much more, in some ways, is a much more rapid way to get exposure into these markets, and you see massive growth in private markets, particularly in these developing markets.
We're going to get to private markets in just a second, but just lastly, you mentioned China. Would any of you go so far as to say that China is uninvestable now? No.
Definitely not.
No, it's not uninvestable.
Yeah.
So you would all still have clients with.
So look, China's market cap is $5 trillion lower today than at its peak. Is it uninvestable? No. It's heavily regulated. If you look at any companies that are heavily regulated, they usually trade at a discount to the broader market because of that regulation. You could say the whole China market is heavily regulated, so there should be some discount. The question is how much? And then where do you find individual opportunities where there still are some? So you don't worry necessarily about the beta of the market. You're looking at individual opportunities, maybe towards domestic consumption, like we were talking about in the last panel. But it's investable if you pick your spots and you recognize that it's a heavily regulated entire broad market, not just sector.
But
I think, Zanny, I was going to say, because I was listening to those two, at a very high level, when you think about how people are committing capital, they're looking for valuation, economic fundamentals, and political risk. And I think it makes any part of the world, you could look through that sort of very simplified lens. It could make Saudi Arabia very attractive. It could make China very attractive. I think when you start saying uninvestable, I think that seems way too extreme to me, because there are many people that would say the valuations look incredibly attractive, to Mike's point, and that they represent where they should be. And that's when you get into the relative value conversation.
Yeah, that's absolutely right. I mean, uninvestable is a kind of, journalistic simplify and exaggerate, but it was to make a point which it is much less attractive on all of those metrics. Let's turn to private markets.
I will never debate linguistics with you. Ever.
Let's turn, and Javier, I'll stick with you. Let's turn to private markets, because that has been one of the, if you just sort of look in over the last 10 years, but certainly the last 5 years, dramatic shifts, both on the equity side and in debt markets now. Is this inexorable, and basically to be another, journalistic oversimplification, are we going to end up with, all private and no public markets?
Yes. Everything will be private in the next 5 or 7 years, certainly before I turn 70.
Elaborate. No, seriously. What is driving this, and how inexorable is it? How much further is it going? Yeah, to you, and then I'm going to ask others to jump in.
Okay, so again, it always feels like these phenomenons are like happening like in the moment, but the reality is, if you step back, this is a 30-year phenomenon where you basically started with a barbell, right, of buyout of public companies and VCs, and so you had early formation capital that came in for companies at their startup phase, and then you had later stage, mid-stage buyouts. All that's happened over a 25, 30-year period of time is that you've had all the formation of capital actually fill in, and I think the stats from like 99, 2000 were from initially receiving capital, a company would go public in the United States within a couple of years. Now it's as much as 11 years. It's not that they're not wanting to be public, it's that the private markets have given them the option to stay private for longer. They can participate in the growth for longer, and they can actually change hands in terms of ownership, and that can be quite attractive. I think when the need for public market capital is the desired choice, they'll tap it, but clearly private markets are playing a much more significant role in company growth, and I think that trend will continue.
Mike, this is a sort of meaningful change in your world. Is this inexorable, and what does it mean for public markets?
So the public market capitalization globally is $100 trillion. In 10 years, if you just assume long-term capital market assumptions of 7% for equities, that $100 trillion will be $200 trillion. So the public markets are healthy and here to stay, and they're liquid. But I think we're in a world of and, not or. And I think that's a huge theme, because you could say, Ron and I chat about this, active and passive. A lot of our clients will use both, and we're going to try to help them do that. Public-private, same thing. So I think it's about, ultimately, what's the end client's needs, what's their liquidity needs and profile, and how to best accomplish that in a right fee level and in a right excess return level. So I don't think it's a debate of active, passive, and public-private. I think it's a debate on proper portfolio construction.
Ron, first of all, I'm assuming you agree with Mike, but if you don't, give us a different perspective. But secondly, two of the concerns about private markets are, one, that they are more opaque, there's less transparency, and secondly, that there's less liquidity. So even if you will, I'm sure, I'm joking aside, you will continue to have both, of course, but if you do have a continued shift, what does that mean for the functioning of markets?
Well, first of all, I do agree with Mike, but secondly, your point on liquidity, I mean, and investors are being paid for that. There is an illiquidity premium in private markets that, in theory, investors should be paid for. So going back to Mike's point on an and, I think what, if you think of what private markets have done, and I'd like to come to private credit in a second, what private markets have done is it's actually deepened capital markets. It's given alternatives. It's given those that are investing, they can make decisions on, I need a lot of liquidity. I want the ability to get out tomorrow. I'm going to be more oriented towards public. I'm a long-term investor. I'm a retirement investor. I actually don't need this money for a long time. I actually want to get paid for the illiquidity premium. We didn't talk, Harvey was talking about private equity. Really like to talk about private credit too, because that really, its growth is the product of a changing view towards banks. And particularly coming out of the global financial crisis. If you think about what a bank is a concentrator of risk. And we saw that in a very big way in 2008 and afterwards. The encouragement of private markets is the exact opposite. Private credit is a distributor of risk. And so to have both on hand is actually quite important.
Jane, this is now an obvious point to turn to you. I mean, I'm assuming you agree with Ron in terms of the reasons for this, but what does it mean for you and for the kind of ecosystem and relationship between banks and private credit?
We need a new equilibrium, and it's wonderful to see innovation happening in the financial system. We want that to occurring all the time. If it goes out of balance too much one way, too much of another, that's never ideal. And we've seen it where on the public side, for example, the IPO markets, a lot of the sponsors are fairly gummed up in their ability to find exits the way that they would like at the moment. So you want to make sure that there's a diversity of opportunity. And that everyone adapts to the new innovations that are out there. As a bank, we certainly look at our role as being important in terms of origination capabilities, but also often distribution into private asset market. And for the clients, there are many times they may want to go direct to private asset. They may want to go through a bank because we're also providing a range of other services and capabilities that other players who are more specialized do not. So I think different participants have different roles. Making sure we've got something that's in equilibrium is important.
But just to be clear, are we in equilibrium right now?
I think we're at the end. I think we were in danger of going out of equilibrium. The new Basel III rules and other elements, how they could get interpreted, could push us out of that. So I think that's why you've seen a lot of the banks pushing back on those rules, because we don't think it's good for the system. But I'm certainly not in the position that there is a zero-sum game here. There is a win-win to play for, and I think it's contingent on all of us to try and get there.
But do you think we're going to be in a world where private credit continues to grow?
Yes.
Anybody disagree with that? Do you all think that, Mohammed?
Actually, Zanny, I really loved your initial question when you added an adjective to what is the future, and you said, is it inexorable? And I think it's more cyclical rather than that. And if I can just illustrate why, if we go back to the 50s and 60s, the primary, most successful form of publicly traded business was the conglomerate. And the conglomerate was a private allocator of capital. And it was a private allocator of capital back when we thought markets were inefficient. So they did a better job of allocating capital than markets did. And markets actually gave them a vote of confidence, because markets were saying we are inefficient because most active managers also outperform the index. If you fast track 20, 30, 40 years later, as markets become increasingly efficient, there are no returns to, or less returns to active investing, more people realize that I need now to move one step beyond in order to try and generate alpha. And this becomes a question of, are you likely to expect passive investing to grow indefinitely? And if it grows indefinitely, then this will, in and of itself, have an impact on the allocation and the efficient allocation of markets. The reason I'm saying all of this is because in most emerging markets, Saudi Arabia as an example, we are starting from the other extreme of that cycle. We are in markets that are still not efficient. There are high returns to active management, and we see this in the returns of active versus passive. Markets in our part of the world are highly concentrated. So you have big anchor investors who invest long-term stakes in publicly traded businesses, where you get a lot of the benefits that generally are sold with private equity, which is concentrated ownership, along with transparency, disclosure, and minority shareholder protection. So I do think it's cyclical rather than
So that's a really interesting perspective. Harvey, when you hear that perspective, A, do you agree with it? And B, do you therefore think that we're going to see similar developments in emerging markets that we've seen over the past few years? They're much earlier, so the move to private will take longer. But do you also think then, because the definition of cyclical is that it goes around, so we will come back then to a world where private is not so dominant?
So I think, I think you have to, some of the points made here where I thought were very insightful. I think embedded in Mike's observation about the growth of the public capital markets is just, are you optimistic about the growth of the world and the growth of economics? If you were super pessimistic and you thought we're going to go into a multi-year recession, Mike might say something differently, but I happen to be with him, and I happen to be quite optimistic that we'll navigate the next 5, 10 years quite successfully as a global economy. If that's the case, the capital demands are high. If the capital demands are high, and we have developed really over the past 30 years, the innovations in capital, and very often as a system, we don't get it right. We did have a financial crisis, but that capital will find a hyper-efficient way to be put to work. And so again, when I was talking earlier and I said, you had VC and LBO, now you've filled out the entire capital structure. And it's not like when, Jane and I talk, we're not frenemies. She's not thinking, what business does Harvey want to steal from me? We talk about the fact that I'm a client, how can we partner together? Are there assets that she thinks would be in my hands? And, she said origination earlier. I don't want Jane's clients. I want to be an efficient allocator of capital, and if she can be a partner of mine and we can work together, I think the ecosystem of capital markets, again, finds its way. But the point on cyclicality is certainly well noted also, which is we're going to have these moments where they dynamically are changing very, very quickly, and then they'll stabilize. But if you look at businesses in around 25, 30 years, like the CLO business, one of the largest in the world, that is a business that is completely dependent on working with banks, has been for a long time. Nobody talks about it because it's not news. And I think it's fantastic what's happening in countries like Saudi Arabia and around the rest of the world, because they can avail themselves of all the mistakes we've made and all the smart things we've done, and they can incorporate it. And I think it just accelerates their growth. And as quickly as they can, as Mohammed describes, get through the challenges they have of building out their capital markets, that's what allows this hyper growth. So I'm pretty optimistic.
But I'm going to turn to Mohammed in a second, because does it make a difference as a regulator in this world if you have even if Saudi Arabia is in a slightly different position, but broadly a world where you have much, much more focus on private markets, both in equity and in debt, is your framework as a regulator having to be different?
Undoubtedly. So I just want to pick up on the last point. While it is cyclical, there is a cycle to this. First of all, there are things that you can do in regulations to either accelerate the cycle or slow it down or even reverse it. One of the most important things is how easy is it to be a public company? How easy is it to become a publicly traded company and to remain a publicly traded company? And the more difficult you make that, the more that friction necessitates or creates a preference for private businesses. And that is something that I think we, as an emerging market that is dependent on capital markets, are acutely aware of, which is the balance between investor protection and between attracting businesses that want to list and want to get raised through the capital market. The other thing that we are increasingly aware of is transmission mechanisms between private markets and public markets. Until quite recently, private markets compared with public markets were so small that the transmission mechanisms weren't as big as to be a concern. Today, given the size of private markets, the growth of private markets, and the leverage of private markets, those transmission mechanisms are becoming increasingly important to monitor and to make sure we have a handle over.
And just picking up on Mohammed's point as well, I mean, we're seeing, from a regulatory point of view, some arbitrage going on. A fair amount of the private asset is going into insurance vehicles. That's a more effective one. Part of that is arbitration between the banking and the insurance regulation, and what is the more efficient mechanism for then distributing that and placing that capital at the end of the day. So there are different dimensions to the regulation that we all have to think about. And unfortunately, usually it takes a crisis for some of the regulatory frameworks to change, for better or for worse.
Do you think that the system, much more private dominated, Mike, is more resilient if there is a crisis now, or less resilient?
I'm not sure it's about resiliency. If I had a concern in private credit in particular, it would just be the amount of money chasing an asset class where you need a really strong infrastructure to do it well, to be the investor, the originator, the banker in private credit. A firm like Harvey's firm has the resources to be excellent. It requires hundreds of people, not 10 people in a Bloomberg machine. Mm-hmm. So I think it's important when we think about the health of the system. I think the majority of the assets are in the larger private credit managers who are really fully built to manage what can be a challenging illiquid asset class. The more that expands and the more folks get involved without the resources required to do it, you'll end up in some illiquid situations where you have pretty high drawdown risk. But I think when I look at the largest private credit managers and their capabilities and resources, I'm not worried personally about them and their ability to deliver returns to their clients over a long term. I worry about the long tail.
Yeah.
I do think, though, having a robust private credit market is actually helping us as we speak. I mean, in the US, there's pressure on the banks, particularly those that are highly invested in commercial real estate. And having alternative sources of lending is actually quite important. I do think where Mike's point really does come to bear is what actually happens if there's a truly a financial crisis like 2008 or the 30s, and going back to that, because banks, we don't talk about this a lot, banks play a very important role in workout, right? Ultimately, the loan needs to be worked out, and banks have an interest in getting the borrower back on his feet, her feet, its feet. And how does that actually work in private credit, where the credit is distributed very broadly, is something we don't really know yet. We haven't seen that. So I think how this is all going to work, if in that eventuality, is something to be thinking about. It may be a risk.
Well, I think it's when, right? At some point there will be that kind of a crisis, and you're right. It will be worked out differently in a world of lots of private credit. Let's turn to another big shift, which is how we are going to fund the tremendous capital requirements that digitization, the AI revolution, decarbonization will require. I mean, I think it's 8 trillion of capital required only for decarbonization alone. How you see on the horizon these tremendous requirements for capital. What is that going to do to the way the financial system is working, the kinds of, how is it going to be done? What kind of asset classes? I put this to anybody, but Mike, let's start with you, because how do you keep hearing these numbers, right? And how is that money going to be mobilized, and what will it mean?
Well, I think the way I would answer that is looking how companies are assessing CapEx. So if you look at 4 companies, Alphabet, Amazon, Meta, Microsoft, in 2024, their aggregate CapEx will be $200 billion, which is a huge number. It's up 30% year on year. Where are they going to spend a bunch of that? It's towards AI, large-scale computing, infrastructure, data centers. So when you talk broadly about infrastructure, there's different forks in the road of infrastructure. As it relates to the power needed for AI, it's huge. And I think you'll see a lot of CapEx headed towards satisfying that demand.
You're also going to see, well, I'm going to go first to Mohammed, to you, because many of the demands of this capex are in emerging economies, which are not getting it right. If we're going to do the climate transition, a lot of this stuff has to be in emerging economies. As of now, that money isn't being mobilized. What needs to change for that money to be mobilized?
Zanny, I mean, in your previous question, at least in Saudi, we are a living manifestation of the financing needs, not just of the global economy, but of emerging markets more specifically. If we take a look at how Saudi has operated in the past 50 years, we have naturally been a big exporter of oil, and that's what the country is known for. A lot less is known about our second biggest export. And the second biggest export of Saudi Arabia over the past 50 years was capital. We are, on a per capita basis, we were possibly the biggest exporters of capital in the world. As a result of both global trends in terms of sustainability, transition, technology, but also local challenges of diversifying the economy away from oil, building additional industries, building new cities, et cetera, we've had to ramp up massively our investment requirement and our aspiration for investment. And if we just put the numbers, this translates into something like $3 trillion of investment from now till 2030 that Saudi Arabia needs to invest in order to make all of these aspirations a reality. And this, for the first time, encounters a possibility of Saudi Arabia transitioning from a net exporter of capital to a net importer of capital for the first time. And the financial markets and capital markets specifically are an exceedingly important fulcrum to do this at this magnitude. Private markets can help, but you need to have very functioning financial markets in order to do this level of transition at this magnitude. And that's why, over the same period, the Saudi capital markets have moved from roughly the 25th largest capital market in the world to now the top 10 largest capital market in the world because of our needs for financing.
But let's stick with you, because it's a really interesting, I was about to say microcosm, you're not that small, but it's a really interesting example of this broader shift. I mean, how are you going to actually mobilize that amount of capital? And particularly given where we started this conversation of the focus of public markets on the US, you know, over a 10-year horizon, are you confident that you can attract that kind of capital?
So, Zanny, in one word, I would say it's globalization. We also have to admit, because Saudi Arabia historically, and again, Saudi is a microcosm of the world, because Saudi Arabia has been a net exporter of capital, we had the perfect excuse to have completely closed capital markets. Not only closed capital markets, we have a closed country. You couldn't get a tourist visa into the country even if you tried. As a result of this changing aspiration and this changing directionality, the country has had to open up to the outside world, open up in terms of tourism, open up in terms of partnership, and open up in terms of capital. And since we've opened up the market to international investors, we now have something like over $100 billion invested just in the country's equity capital market from 4 or 5 years ago. And it is, to us, quite an interesting experience to look at the rest of the world when Saudi Arabia is opening up and the rest of the world is starting to close
Well, that gets back to where the conversation I had with Kristalina and the beginning of our conversation. The world is fragmenting, and yet you're relying on capital coming on in from the rest of the world. I just wonder, Harvey, let's go to you because you're at the sort of cutting edge of this in terms of the kinds of deals that you are now doing and the more interesting things that are happening to try and get capital to these big, whether it's digitization, AI stuff, whether it's climate. Do you think these numbers are plausible? Is this kind of capital going to be mobilized for the places that actually need it, or is it going to be tech companies building data centers?
Well, I think we have to be realistic. 80% of the world's energy comes from traditional energy sources. So the notion that we're going to fix climate or make these transitions in any simplified, immediate way, I think is pretty remote. When I think of the big paradigms that will drive economic activity over the next 10, 20, 30 years, I think energy, you can call it climate, you can call it energy, longevity and improvements in healthcare, and the third thing would be technology or AI. All these things in many ways, they interconnect, but they really interconnect with energy. And the demands for energy are going to be enormous for a number of reasons. We've underinvested as a globe for a long period of time. Economies are growing. You see these massive expansions like are happening in Saudi Arabia. That's just an example. But also there's energy security now is a real issue globally. And so demands for energy. And then you combine chip security and all these other issues. I think the demands will be high. You know, Mike made some, I think, fantastic points about private capital. I think the size of this issue will present opportunities for everyone in this room. I think some money will be lost. I think a lot of money will be made. But I think it's going to come from all sources. I think it's going to come from sovereigns. It's going to come from public-private partnerships. It's going to come from private enterprise. It's going to come from wealth that is now deploying more capital into private markets. Again, I think this is a 10, 20, 30-year opportunity. And some of the transactions that we're involved with, the size is hugely significant because the solutions needed are very significant. But I think this, again, is going to be an extraordinary opportunity, but I think we're in the very early phase of this. And if you want to call it energy transition, I think it's been one of the most interesting spaces for a couple of decades.
Go on.
Zanny, the biggest obstacle to climate and energy investing in emerging markets is not the availability of capital, it's the actual mobilization of it. And the problem has been there's a lot of institutional investor interest in actually participating in this, but there's certain risks they can't take. You know, they can't take currency risk, they can't take country risk. And part of what we need to do to unlock and get the mobilization is completely rethink the role of the multilateral development banks. They ought not be competing with the Citibanks of the world. What they ought to be providing at a much lower dollar amount, but providing that first loss level. And then you can see an awful lot of capital able to be mobilized. You can see deals that are done in a combination of public and private. But right now, there's lots of interest, but no willingness to move because of this notion that there's a level of risk that can't be taken by these investors.
I think political and regulatory risk will be the biggest obstacles to mobilizing the capital.
Yeah.
Bureaucracy will get in the way before capital will get in its own way.
I completely agree, Harvey. There needs to be a public-private partnership here. So let's separate it in two types of infrastructure. The one that we're talking about in terms of these big hyperscalers, $30, $40 billion investments, they have to be in places that have talent, land, and energy in order to build that type of capability. So there's not that many places that can do that and attract capital. And I think that's, as we talked about, a few markets. You've then got other places in the world where you need a basic transmission capabilities being developed. So looking at Africa, looking elsewhere, which is where Ron is going, that we have a sea of unbankable infrastructure projects around the world. So in order to affect any of the green evolution and transition we've got to be solving for transmission, because there is no transition without transmission. And that's going to require permits, deeply unsexy things that need to get put in place. Permitting, contracts, good rule of law. We need to have currency risk that can be hedged, which is where the MDBs step in. They have a tremendous amount of data. And this is, I think, one of the areas RJ is pushing with the World Bank. That data gets into private hands, then the risk factors can get assessed much more easily, and that capital can actually get deployed. But I think we've got to get into the plumbing, as it were, rather than just the capital in order to get there.
It's such a great list, but when I listen to you, I've heard that so many times before over so many years, and yet the MDBs are still not transformed to do this. It seems, anyway, there's a disconnect between the urgency and scale of what needs to happen, Ron, as you lay out, and how little has happened.
RJ is pushing. He's pushing hard. Yeah, good. We need him to.
I want to quickly touch on AI before we round up, which is I want to ask you, and maybe Ron, I'll start with you, how much AI you think is and will transform your industry itself?
I think we're a great example of how AI will continue to transform our industry. I mean, if you think about what we do, we provide technology and operating infrastructure for the world's capital markets and those that participate in it around the world. This is very operationally intensive, highly repetitive kinds of things. Every day that markets are open, we have to be there from the beginning of the market right through when portfolios are cleared and reported on. So the ability to use AI, right now, to date, it's been about machine learning, for us, and there's been lots of ability to take what formerly required lots and lots of people, that the people now, rather than doing rote kind of accounting, what they're doing at the end of the day is checking the machine and making sure that price that's about to be issued. With AI and the kind of Gen AI and the ability to actually use the large language models and address data and bring those together, the ability to, for example, change the client interface and how institutions, I mean, you think about where technology's been applied in user interfaces, it's largely been around consumer types of businesses. So we all love to deal with Apple, we all love to deal even with our bank in terms of how good they are. But in terms of how businesses work with businesses, that's actually not been very automated on a relative basis. AI is a great example that will bring that. So for us, it'll continue to transform what we do. It'll be better for markets because things will speed up even more than they are now, and the risk of errors will go down.
How much of your time do you spend thinking about AI?
It's other than cyber, it's probably the thing I spend the most time on.
What about the rest of you? Is it the single most important? Jane, how much time?
We're working on a lot of different use cases on it at the moment. I think one of the things, a couple of observations, particularly on the Gen AI front, because Ron says machine learning is really been the one that's made the biggest change in trading. ChatGPT doesn't do math. Jenny Johnson Franklin Templeton had a great statement the other day. She said, think of Gen AI as an intern at the moment, fantastic at feeding you information, summarizing. Judgment, not so much. So I think there's some pieces here that we all got very, very excited by. You can see the potential, but actually getting it at scale is proving a little harder than some of us were enthusiastic about. We'll get there, but not quite yet.
Interesting. Mohammed, you...
It's very interesting, the thread we're discussing on AI, and this being generally a panel on capital markets. If we think of capital markets are allocators of capital, if there is an absolute right and wrong in terms of where it is right to allocate capital and where it's not right to allocate capital, then I would think of ultimately automating that decision. But then that begs the question, is there an absolute right and wrong in terms of allocation of capital? And I think what many of the panel here and many in the industry are grappling with, even regulators, is what is the implication of moving judgment away from the capital allocation process, be this through passive versus active investing, be this through AI or algorithmic trading, et cetera. Are there any additional overlays that we now need to put in place once that happens? Or is this an unrequited good? Or when we start to see this grow bigger, we now need to regulate the index providers, we need to regulate the AIs, and is there a limit to this, where when we reach a certain level, we need to say, we need to now reintroduce judgment back into the decision process?
That's going to keep you occupied for a while. We've got just under 2 minutes, and I told you what I would do this. I want to end by asking each of you, and I guess you've got less than 30 seconds each, to answer one specific question, which is we talked about changes over the last 5 years. Imagine we meet again in 5 years' time. What's the biggest thing that's changed in capital markets since 2024? Mike, I'm going to start with you.
I'd say the $10 trillion of cash on the sidelines, half of that makes its way back into the capital markets.
Okay. Jane?
Democratization. So democratization of private equity, democratization of more of the asset classes into people's hands.
So ordinary people get access to it.
Yep.
Great. Mohammed, what's the biggest change in 5 years' time?
Oh, in capital markets, 5 years' time, Saudi moves from one of the top 10 largest markets in the world to probably one of the top 5.
You are very good at your job. Ron?
I think the U.S. gets its handle around its deficit situation, because if it doesn't, we're going to have a real problem in 5 years' time.
Wow. Okay, I'm going to remind you about that. And Harvey, last word is yours.
I think 5 years is a long time to predict anything. People can't even predict the Fed. I think the thing we can be most certain of is that with weight loss drugs, everybody will be skinny in the capital markets. I think that's life's only certainty, and there'll be low cholesterol. I'm personally concerned I'm going to be the last heavy person at the Milken conference. So I'm a little bit nervous about that. No, I'm generally optimistic. I actually think that I think there'll be some transformative things in AI that improve the efficiency of our capital markets. And I'm super hopeful that in 5 years, the geopolitical backdrop wildly improves, because I think it would foster a lot more, everybody would benefit.
Well, that is an optimistic note to end on. I hope you're right. Thank you all very much indeed.